Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Ryan Grabinski. Ryan is a managing director and investment strategist with the firm. We're going to talk all things markets. Ryan, how are you doing today?
I'm doing well, and it's always good to be back, Ross.
Yeah, thrilled to talk to you. A lot going on over this kind of couple week period that we're in. A lot of earnings, a lot of macroeconomic data. So let's start, at the 30,000 foot view, which I think can be best summarized with your all's market gauge, kind of the exercise you go through every now and then to take stock of the market. So could you tell me, where it's sitting, what was just downgraded, and what your outlook is for going forward?
Yeah, certainly. So, our market gauge is something we've published for the better part of the last 20 years. It's actually at the most negative reading that it's been at in the history of our gauge. And, that sounds a little alarming, and we've gotten a lot of questions on it from clients. What does this ultimately mean? I think the thing to keep in mind with it is that it's actually a snapshot in time of what market conditions are. And obviously, a lot of the negative components of it, and the most recently profit margins or earnings growth and profit margins, a lot of them are already known. So the market has been able to digest those items over the last year. And so we understand that it looks really negative and extreme, but it really isn't something to be too alarmed about. Obviously, we continue to have a more bearish outlook going forward, but generally speaking, a lot of what is in that market gauge is already known, and obviously has been something that's been talked quite a bit with amongst clients over the last week since we actually put it out.
Right. And you mentioned, the thing that was downgraded most recently was kind of the corporate profitability, profit margins piece of things. And, to your point, you all have been calling for kind of a weaker profit outlook for a long time. And we are starting to see that realized. We're in the middle of a big earnings season. I think it's better than expected, but earnings are still falling. So could you kind of give me stock of what you're seeing through this earnings season so far and how that plays into your all's outlook?
Certainly, the headlines for earnings season have been this company's coming in better than expected, that company's coming in better than expected. I think, well, that's largely true. A lot of the larger tech companies have reported well. You've seen even some of that with the communication companies. If you look under the surface, there's actually a pretty wide divergence that's actually occurring. So if we look in consumer discretionary, for example, and we focus on, say, the household durables, the home builders have seen blowout earnings so far this earnings season. But if you look at sort of the home appliance companies, they've been talking about how earnings are turning negative. The same is true within the tech industry. I mentioned tech at the beginning, but the software and services companies have seen some blowout numbers. But then if you look at some of the semis, it's actually been mixed. So overall, the earnings growth is still expected to be negative. It's about negative 3.5% now for the first quarter as they've been reported. That's been better than what the initial number was at negative 5.1%, but it is still negative. Our outlook hasn't changed in terms of profits for the full year. One of the things that we're actually watching is the earnings progression on an annual basis. And the 2023 number has not really seen any revisions higher. So despite some of the better than expected earnings headlines that we're seeing, we haven't really seen that translate into overall an increase in estimates for the 2Q to 4Q of this year. And the same can be said for 2024. There's been no increases in the outlooks for the earnings landscape for when you look at it on an aggregate basis.
Right. And so that's the earning picture. And obviously, we're getting a lot of earnings, and that's coming at the same time that we're getting a lot of macroeconomic data that's influencing the Fed. So we know the Fed has been on this rapid hike cycle. We know they're towards the end of that. We're recording on Thursday morning. They have a meeting next week where they're expected, or at least the market expects, a 25 basis point hike. What are you all seeing or expecting from the Fed at this meeting, and maybe for the rest of the year as well, as the economy, as earnings kind of slow down a bit?
Certainly. So, the Fed expects to get another 25 basis points in. If you look at what the market is telling you, the market has a probability of about 90% that they will get that interest rate hike in next week. It's our view here that additional hike is not necessary. Obviously, the pace at which they have increased interest rates has been quite rapid. We know that 7 of the last 9 interest rate hiking cycles have led to recession. So, we're just playing the probabilities in the sense that the probability is high that this one will ultimately lead to a recession. The lag with which monetary policy acts is long and variable. So we have not yet seen the full-blown recession signs yet. I think what is continuing to hold it together is the labor market. Obviously, initial claims had been trending upwards. The most recent data point was an improvement on a week-over-week basis, so that continues to be mixed. But some of the CapEx data is beginning to come in a little weaker. Those are the 2 items that are on our economics team's checklist that are not checked off yet, but we continue to monitor closely. We continue to use this probability of about 75% for a recession over the next 2 years, and we continue to believe that's true. Obviously, the market is suggesting otherwise, and it has continued to hold up here. So we are mindful of that with regards to our call overall.
Yeah, absolutely. A lot to keep an eye on, a lot this week, even more next week. So, Ryan, we really appreciate you carving out some time to talk with us, and we'll hopefully talk again soon before things are all said and done.
Thanks, Ross. Have a good one.